Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 4th, 2023. I hope you're doing well. I hope you had a good trading week, and I appreciate you checking in and dropping by and checking out my weekend review podcast. In the podcast today, the format is as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily charts and the weekly charts. We're going to talk about when I entered the trades, why I entered the trades, and most importantly, how I am going to manage the positions moving forward. After that, we are going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and then actually follow that plan without your emotions without the price movement amplifying your emotions and getting you off track. It's very important to create that plan and follow it. So I do always like to talk a little bit about trader psychology. Always helpful for me to teach it, and I hope that it's helpful for you. After that, we're going to do a quick poem by the trading poet Frank. Always fun, always pertinent to what's going on, and also very helpful for me and hopefully for you as well. After that, I have gone down through my master watch list, both on the daily charts and the weekly charts, and we will. I've identified some potential trades next week, both on the daily and the weekly. What I'm looking for, what the levels that I'm waiting for, both to the long side and the short side. Obviously, in the past few weeks, we have had a massive monster rally. Not quite as many potentials on the long side, although they are there, and I'll show you those both on both time frames, but also on the short side, because we have gotten to some key levels that have been rejected. And so I'll show you what I'm looking for next week. I'm going to show you all the potential entries. Doesn't mean I'm going to take every one. You know, it's in my trading, I look for confluences and combinations of indicators lining up on multiple time frames. The more, the better. The more, if you're going long, the more signals to the long side, the better, because that means there are multiple groups of buyers coming in, and you're going to increase your chances of having a profitable trade if you have as many buyers as possible if you're long, and alternatively as many sellers or short sellers if you're on the short side. So that's the plan for today. First of all, I am going to run the U.S. legal disclaimer, and I will be back in about 40 seconds. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okie dokie. Well, like I said, I hope everyone's doing well. I hope you're having a good weekend. If you're long last week, you had a great week. Happy for you. Boy, this has been an incredible rally. It really has. And, I was thinking about this morning as I was preparing for the podcast. And I think the key here, the point I want to make is that if you have a plan and the plan is working, we always have that kind of part of us that goes, oh, that's too high, I just want to take it. But this rally has shown that if there's nothing to do, if your strategy, your process is telling you there's nothing to do and it's going your way, just sit on your hands. Don't do anything unless your system or your process tells you to do that. And I'm going to talk about that in trader psychology as well, because we need these large moves occasionally to pay for all the small losses. And if we cut our gains too quickly, it always feels good to take those gains. But we need those large moves occasionally, a few times a year. That's what puts money in our pockets as traders. So I'll get to that more when we get to the trader psychology. So all right, let's start off on the daily, on the new trades that I have on the daily. So on Thursday, I did take a long position in VIX here at 1117, and the reason that I took this was first of all, we went under 30 RSI and over 30 RSI. That's just the main signal. Cherry on top, or other signals that help strengthen the entry, but I wouldn't take just based upon that, are the rejection of the negative third ATR channel. You see the negative third ATR channel down here? Well, 92% of prices, when they get there, tend to bounce. You can see over here it bounced a little bit, here it bounced a little bit. But here right now, the confluence is the under 30, over 30. That's the main signal. We have the rejection of the negative third ATR channel, and we also have a V1 entry trigger. Now, I do have a video in my playlist on YouTube called V1 and V2 entries. They really help with your trading, especially if you have a main signal like an under 30, over 30. And the V1 is the day before was bar 1. Bar 2 goes below bar 1's low. That's the washout, and then closes above bar 1's close. So that's the V1. But if you'd like to, go to my YouTube channel in the playlist, watch the video, V1, V2 entries. It's also in the description of this YouTube video down below as well. All right, so that's the trade. Now, whenever I make a trade, what I first do is I have to position size. It's very, very important, and I do this on all my trades regardless of the time frame. But let's just start with a hypothetical $100,000 account. Or let's go $200,000 account today. Change it up, right? $200,000 account. 1% of 200,000 is $2,000. If you have a $100,000 account, 1% of course is 1,000. So a good rule of thumb is 1% of your total trading capital. Let's just go with $200,000 hypothetical account times 0.01. Of course, that's going to be $2,000. Now, $2,000, what do I do with that? I take that number and I divide it by the value of the 2 ATR. That helps me position size based upon the volatility, the movement up and down of the last 20 days, and that's the number right there, ATR 2. So I divide that by $1.07. That tells me to buy 1,869 shares. That shows me how much to buy. Now, what do I do with that? So of course, I'm going to buy 1,869 shares, but then I take the value of the 2 ATR, which is $1.07, and I place that below my entry exactly. So if 1,869 shares move $1.07, and this is the red line down here, then I lose the $2,000. So now this doesn't mean that every trade that I mean, ultimately, yes, I am risking $2,000, but your emergency stop is only going to be hit about 5% of the time. That's the worst case scenario. I wait for the end of day to make my decisions. But if I ever hit my emergency stop, regardless if it's 1 minute after the market opens or 1 minute before the market closes, now I'm out, because the $2,000 number, that's the maximum I'm going to allowed to lose. Now, that's the emergency stop. Now, the end of day stop is just going to be the opposite of why I bought this. And the main reason I bought this was the main signal was the under 30, over 30 RSI. That's the signal. Now, in the days to come, if it does close below 30 RSI, I will get out. But the closing below 30 RSI most likely will be above the emergency stop. So, I have 5 different trading approaches that I use. I use deep dip buys, which is using the under 30, over 30, like the VIX I'm just showing you. Another deep dip buy would be rejection of the 200 SMA, 300 SMA, 250 SMA. So those are the deep dip buys. And that's one of the approaches that I use and I teach. The second approach that I use are higher low V1s, V2s. The third one that I use are return to value, V1s, V2s, some of my favorite strategies. I also use moving average crossovers, and I also use double bottoms with bullish divergences. So those are the 5 approaches that you're going to see me teach and and show you here when I go through the trades that I have. Um, in this podcast, I do my very best to kind of explain what I'm doing, but there are a lot of rules, especially with managing the trades as they go up. And, if you're interested, I do teach private one-on-one lessons in the evening time via Skype. I really love to teach. I've been teaching for a long time. I've taught students from all over the world. And I teach it in a format of one-on-one. I think that's the best way to learn anything. And the course that I teach is a total of 15 hours of one-on-one instruction in the evening time via Skype, you and I. And there's 5 sessions. Each session is 3 hours. So it's a serious course, but if you really want to learn how I trade, I will teach you step by step. And if you're interested, my email is in the link of the description. The course does cost $1,750, but I promise you it is worth every penny. And I've had so many students over the years, and I know they're really glad that they took the course. So, all right, so let's get back here. So under 30, over 30, V1 entry trigger. Rejection of the negative third ATR channel. I position size based upon taking my maximum allowed loss, dividing by the 2 ATR. That shows me how many shares to buy. It also shows me the level where to get out if I am wrong. My end of day stop, again, is just a close below the 30 RSI. And that's going to happen about 95% of the time. So that hypothetical $2,000 loss, that's the worst case scenario, but most of the time it's going to be much less than that. And if I did my setup correctly, hopefully it will go up, but we always have to look at risk first. So one more line here that I want to point out is this orange line here. This is 1.5 ATRs above my entry. If I get to that point, then I go into trailing stop mode, which means that if I then have a close below a previous bar's low, then I'm going to get out of half of the trade. It's just a way to tighten up your stop. In addition to that, as prices move up, I have a formula that I use where I take off 10% of whatever shares I have remaining if it moves 0.45 ATRs from my entry. So just to show you here, for Monday, I take the closing price, 1132, and then I look at what my 0.45 ATR is. Right now it's 0.24, so I add 1132, add 0.24, whatever that is, that's going to be my first profit target. Now I take my first profit target, add the 0.45 to it again. That's going to be my second profit target. I'm going to take the second profit target, add the 0.45 ATRs, which is 0.24 to that. That will give me my third. So every day I have 3 profit targets in the system as limit orders that if they move up, I don't have to do anything. They're just in the system and they'll take it off, but only 10%. So that's the offensive part of the trading. The defensive part, of course, is emergency stop, end of day stop, trailing stop levels, as I just mentioned with the 1.5 ATR trailing stop level. But the offensive part is selling into strength a portion of the position. And by doing that, it always starts reducing your risk because you're taking a portion of the profits off. So under 30, over 30, V1, rejection of the negative third ATR channel, position size, place the emergency stop. I know where my end of day stop is. And so far, this trade, it was up 0.98% on Friday. And let's see, I got it at, so I'm up 1.24% so far on this trade. And again, if I get to trailing stop level, then I go into trailing stop mode. And right here at the open, see, I put the 3 profit targets on Thursday's close, and right at the open took 10% off. Already took that off. The market can't take it away from me. Reduce my position size. And so that is how I trade. So this particular position so far doing quite well, up 1.24%. All right, Apple, had a great trade on Apple. And I took this all the way back here on the 12th of January with, over here, with almost exactly the same trade or the same setup that I showed you on VIX just a minute ago. Under 30, over 30, under the negative third channel, over the negative third channel. I bought it here at 129.50, position size correctly, place my emergency stop 2 ATRs below. My end of day stop is a close below the 30 RSI. This day almost got it. It actually went under 30 and over 30, but it closed over, so I held it. As it moved up, I took profits with my partial profits. Here, I got out of half of my position. So I got in at 129.50, got out of my half of my position here at 133.40 because it went above the 50 RSI and below the 50 RSI. Again, these are some of the rules that I have with an under 30, over 30. That's what I teach in my course. Got out of half here at 133.40, but then it just continued up, continued to take partial profits, partial profits, partial profits, partial profits, partial profits, partial profits, and then orange line here is my 1.5 ATR trailing stop level. After that happens, I'm just waiting for a close below a previous bar's low. Did not happen until here, 143.06, when this bar closed below this low. So it got out of half at 133.40, got out of the remaining portion of the trade at 143.06 for a profit of 9.45%. So I got out, and then of course it's moved significantly higher. We had earnings. I never hold through earnings. I mean, obviously, I wish I would have held it, but that's what my plan showed me to do, and that's what I did. So that second half got out of the remaining amount with a close below the previous bar's low after reaching the trailing stop level for a profit of 9.45%. Microsoft. Well, this one did not work out so hot tamale. I shorted Microsoft here on the 1st of February with a rejection of the 200-day moving average. In this case, I position size. I placed my emergency stop up here. My end of day stop is just to close above the 200. Well, next day really got me, went up, almost hit my emergency stop. Didn't quite get there. If it had hit that earlier in the day, I would have just gotten out, but I waited until the end of the day and got out here for a pretty big loss, 4.38% loss on this big move up. And then I got out, and then Friday it was down again. Oh, well, what do you do? All you can do is follow your plan. So this one, loss of 4.38%. So on the dailies, just to recap, VIX, long VIX, 1.4%, 1.24%. Profit at this point. One other thing I did want to show you that I liked on Friday was MACD crossed over. I wouldn't take the trade just based upon MACD, but it was a good confirmation of my trade that MACD finally went positive here, which it hasn't happened for a while. And the other thing I guess I didn't mention, you see the low we had here? Do you see how deep the RSI level was? Well, on the day that I took the trade, it was lower than here, but the the RSI was not as low. That's called an RSI divergence, which is showing that you're running out of sellers, and the implication of that is that you will move up. So these are all the things that I teach in my one-on-one course. And there's a lot of things to learn. You know, I've been trading for 28 years, and so sometimes I look back at these charts and I was like, oh, I forgot to mention this and I forgot to mention that. But yes, RSI divergence here in addition to the setup and the entry signals that I told you before. So in the money here, 1.24% on that trade. Apple got out of the remaining at 9.45% profit. And then on Microsoft, this one was a bad short trade that did not work out, but it was a good setup for a loss of 4.38%. All right, let's go to the weekly bars. QLD. QLD is double leverage QQQ. And I did enter to the short side QLD Friday at the close at 46.10. Why did I do that? Well, we rejected the 200-week moving average. So I position size, I place my emergency stop, any close above on Friday, because Friday are weekly bars, or weekly bars close on Friday. If it closes above the 200-day moving average on Friday, I will just get out. I place my 1.5 ATR trailing stop level here to the downside. If I If it does happen to move down here, then I'll go into trailing stop mode to the upside. And then if I get a close above a previous bar's close, I will cover half. In addition to the rejection of the 200, you see this bar back here on 9/16/22. See the big down bar? Well, whenever you have a big down bar, if you rally back up to halfway, and of course we rallied to halfway, this is a Fibonacci point here of 50%. If you rally back to halfway there, you're probably going to run into some resistance. And that's exactly what we did here. This bar went above the halfway of the bar back on the 16th of September, and then closed back below. So that's the confluence of signals. Yes, we rejected the 200-week moving average, but I also saw the big bar over here where we went above halfway and then closed below halfway. So that is the confluence, the combination that I'm looking for. And this particular trade, so far, I did get it a little bit higher. This particular trade in the money, 0.74%, but it's a brand new short trade. All right, SSO. SSO, I bought this back on 1/6 with a close under, close over the 200-week moving average. It's also a higher low close. See, this was a lower low close where we closed below, closed above, still did well, but then failed. But this is a close under, close over the 200, and this low is higher than this low. Higher low, anything under 30, over 30s, under 200s, over 250s, over 300s, whatever. Higher low closes are always better because the people that bought down here bought the lower low close. As it rallied and then got weak, they got out. This caused the second move down. But the higher low close, everyone has sold. Everyone that wanted to sell sold here. People that bought here, it rallied, then it sold again. So higher lows, what they're basically, you have higher lows. What's the best way to put this? Higher lows are setups where there are fewer people going to sell into you, and it makes for an easier leg up. See, the lower low, yes, it bounced and then failed, but higher lows tend to have easier movements above because everyone who has wanted to sell has sold. So anyway, bought this here at 45.60. I position size based upon using the 2 ATR. I placed my emergency stop all the way down here, 2 ATRs below, and then my end of week stop on this particular trade is simply a close below the 200. The next week we went below, but at the end of the week closed above. Then we tested it again, closed above. You can see the orange line up here is my 1.5 ATR trailing stop level. This week I got to it, which means that in the future, if I have a close below a previous bar's low, I will get out of half. The offensive part, as it moved up, I took some partial profits here. I took some partial profits here. I took some partial profits here. And this has been a fantastic trade. SSO is double leverage SPY. This particular trade up 11% on the so far from entry. So great trade there. IWM. All right, here we go. IWM. I have been in this for a hot minute. I bought this all the way back here on the 14th of October with a rejection of the 300-week moving average. Let's see, where's my, here we go. So it went below the 300 during the week, closed back above. I got in at 167.19, placed my emergency stop down here. My end of week stop would have just simply been a close below the 300. Never got there. Here's my 1.5 ATR trailing stop level. Again, as it moves up, taking partial profits, taking partial profits. Then I got to my trailing stop level. Doesn't mean I do anything, but now I'm waiting for a close below a previous bar's low, which happened here at 178.70, but I did get in at 168.19. I still have half of the position. The last week, you can see we had a huge week up, definitely took some more profit targets off there. This particular trade on the remaining shares that I have, entry to current price, up 15.11%. So amazing trade there. KMX. All right. So earlier in the show, and most of the trades that I've shown you have been deep dip buy strategies, but this is a different strategy that I use. This is called a higher low V1. The rules for that, we have to close below the -1 ATR channel. These are the two lines here. We have to go into the value zone. This is the value zone anywhere between this green line and this green line, or this green line, this area here, the value zone. But then I created a V1. And again, a V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That is the entry point. Of course, I position size, I place my stop 2 ATRs below. Now, on a higher low V1 or V2, my stop is halfway of the washout bar. So you see how close my stop was here at $65. I got in at $65.40. My end of day stop is just a close below halfway of the washout bar. And again, in my YouTube channel, V1s, V2s, we'll explain this in more detail, but that was the trade. Emergency stop, end of day stop, just a close below halfway. You can see the next week it went below but closed above, had a nice move up, took some profits. Of course, had a huge week up, took some profits here, got to trailing stop level 77.90. So now I am in trailing stop mode on this particular trade, and this particular trade, entry to current price up 16.38%. And over the last few weeks, I've shown you some really excellent trades, especially these higher low V1s and V2s. Tesla was a monster trade, and I had a bunch of others. I can't think of them right off the bat, but this is a perfect example of a higher low. See, this low is higher than this low. V1 in the value zone. And again, these are the strategies that I teach in my one-on-one courses, and I'll teach you step by step. Like I said here, I try to show you, basically what I'm doing, but there's a lot of things kind of left out because we just don't have 3 hours to do the podcast to show you everything. But again, great trade here, up 16.38%. Now I'm in trailing stop mode, just looking for a close below a previous bar's low. WBA. All right, here we go. Well, this was a return to value V2, a little different. Haven't had those for a minute. First requirement on a return to values, we have to close above the value zone. The value zone are the two green lines here, the 1 ATR channel and the -1 ATR channel. Got above, return to the value zone, had a couple days of sideways motion, and then we created a V2. Here is bar 1. Bar 2 goes below bar 1's low, then bar 3 closes above bar 1's close. Got in at 36.90. It's 37.09. This one has not really taken off yet. Let's see, we're up about 0.67%. But when I took the V2, of course, I position size, place my emergency stop 2 ATRs below, and then again on a V1 or a V2, where is the end of week stop or end of day stop? Halfway of the washout bar, the bar 2 bar here. And so bought it here at 36.90. Last week we did come down, test that halfway, which happens very often, and then bounced off it. So in the future here, if we close below halfway of the washout bar here, if I close below 36.10, that will be the signal to get out of the trade. Of course, if I hit my emergency stop down here, I'm going to get out, but I've already position size. I know what my maximum allowed loss is, and then I have my end of day stop, or not my end of day stop, I have my trailing stop 1.5 ATRs above my entry. If we get there, I'll get into trailing stop mode, but not there yet, but still up 0.67% on the trade. And then last but not least, Google. I did exit Google this week, very close to the top. And the reason why did it get out? It didn't hit any of my trailing stop levels, nothing in my process that showed me to get out, except that we had earnings. And I never hold through earnings. It's a good way to lose a lot of money quickly. It's also a good way to make a lot of money quickly if you're right. But, you're just guessing, you're just gambling on earnings. So our responsibility as a trader is to manage risk first, not think about profits. And holding through earnings is, like I said, it's a great way to make a lot of money quickly, but it's also a good way to lose a lot of money quickly. And I didn't want to do that. And in this particular case, it did work out well for me that I did get out, because Google missed on their earnings is down. So first of all, why did I take the trade? Well, I took the trade because we had a higher low. See how this low is higher than this low? Rejection of the 250-week moving average. Again, deep dip buy strategy. Bought this here at 88.90. Position size, end of week stop is a close below the 250. The next week it did go below, but then closed back above, held in there. Next week did go below, and then closed back above, kept me in the trade. Then it started its move up, started taking profits here, started taking some more profits on this bar. Next bar, I think I hit one profit target. This week, I hit 3 profit targets on this particular trade. Got to the orange line, which is the 1.5 ATR trailing stop level. So I'm in trailing stop mode. But again, we had earnings, I think it was on Thursday, and I got out of the entire trade here at 107.69 for a profit of 17.23%. Pretty amazing trade, right? So just quick recap on the weeklies. I am short QLD here because of rejection of the 200, so far in the money, 0.74%. SSO, higher low close back above the 200. This is up 11%. IWM took the rejection of the 300 SMA. This has been a beauty trade. The remaining shares up 15.11%. KMX, higher low V1 was the entry signal, up 16.38%. WBA, return to value V2, this one up 0.67%. And then last but not least, again, Google, rejection of a higher low rejection of the 250 in at 88.90, got out because of earnings with a profit of 17.23%. Yeah, pretty amazing trades, really. And, I guess the point that I'm going to talk about here when we get into trading psychology is the reason I could have at any point went, that's just too high, that's just enough. But my trading process just told me, well, it's moving your way. Don't do anything. If there's nothing to do, don't do anything. And I'm sure glad I did because, I don't know if we're going to have another move this year this big again. I don't know. I mean, these have been such big double-digit moves here, and if I would have got scared and just wanted to get out, then I would have missed this. So this is a good time in the market to talk about what I'm going to talk about in trading psychology. And let's go to this. This is from the Divergent Trader, Alan Edwards. Please follow him at Trader Divergent over on Twitter. He has such good posts. They're succinct and helpful. I like reading them and teaching about them. It helps me, and I hope it helps you. But let's see what he has to say here. Taking profits early can be a bad habit to get into, and once created, can be hard to break. You need to sit down with yourself and think about how this will affect your results in the long run. Change your mindset from a short-term thinker to a long-term thinker. Isn't that good? And it's so true. See, here's the thing. From an evolutionary standpoint, when we used to plant crops, if the crops grew a little bit, we were always scared that a frost would come and it would freeze our crops. So we wanted to go in there and take something while there was something to take. And that's in our DNA. That's still in us. And that's why it feels good to take profits. But like I mentioned, you have to have enough large winners to pay for all those small losses that you're inevitably are going to have. And I know it feels good to take profits. It does. And that's why I do take partial profits. That's part of my process. But, human nature is, if something goes down, it's easier to hold on to it because, hope springs eternal. We're always thinking about, well, it'll probably come back. It'll probably come back. It'll probably come back. That's exactly what you don't want to do. And then on the upside, we do the opposite. We want to take profits quickly, which is exactly what you don't want to do. We need those large profits to pay for all the little losses. So I guess what I'm saying here, be very patient with your winners. Be patient with them and be very impatient with your losers. But most traders are very patient with their losers and very impatient with their winners. And that you're not going to make money doing that in trading. So let's read this one more time. Taking profits early can be a bad habit to get into, and once created, can be hard to break. You need to sit down with yourself and think about how this will affect your results in the long run. Change your mindset from a short-term thinker to a long-term thinker. Good stuff, and so true. Please follow Alan Edwards over at Trader Divergence. All right, let's do a little poem for my good friend Frank. You can follow Frank at Franco D over on Twitter. Today's market poem, Trailing Stop Mode. Well, you heard me talk about trailing stop mode when we were going over my positions. That is a trader's favorite road. That's true. I love when I get to trailing stop mode because then I know almost regardless of what happens, I'm going to have a profitable trade. So trailing stop mode, this is a trader's favorite road. We've locked in profits and lightened our load, right? We've locked in profits, lightened our load. We've gotten out of part of the position. We've reduced our risk and locked in profits, raking in gains from the seeds that were sown. It's the reward that comes from following our rules and code. That's exactly right. Trailing stop mode. This is a trader's favorite road. We've locked in profits and lightened our load, raking in gains from the seeds that were sown. It's the reward that comes from following our rules and code. And I could not agree more. When I get to trailing stop mode, I know if I have a close below a previous bar's low, I'm going to take half. Taking half is one of my favorite things in trading. It's really about one of the only win-win situations there are, because if you take half and it keeps going up, well, you're glad you still half-half. If you take half and it goes down, you are really glad you sold half. So, again, that's what I teach in my course. That's what I teach in my process, and taking half when you're in trailing stop mode. And that's why this particular poem is so relevant to me. So trailing stop mode, this is a trader's favorite road. We've locked in profits and lightened our load, raking in gains from the seeds that were sown. It's the reward that comes from following our rules and code. Thank you, Frank. And please follow Frank at Franco D over on Twitter. Okay, well, for this coming week, what I'm looking at, let's start with the daily positions. First of all, and I want to point out that, what do I have? 12 symbols here. If they all get to where I need them to get to, I'm not going to take them all, right? I'm going to take the one at the moment that has the most confluences, combinations of indicators on multiple time frames lining up. So what you're going to see here as I go through here, you're going to see me, these are the dailies, so I'm going to be looking at the daily, but I'll also reference back to the weeklies as well. So here is Alibaba. Well, Alibaba's had a huge move up, beautiful trade off of the 200. I didn't take that, obviously. I wish I would have. Great risk to reward ratio and a great move up. But now we have started, we got up, we started running out of momentum, and we have gapped down and we've continued down. So this is a big move up, quite natural for it to pull back, but I want it to pull back to a level that has support on multiple time frames. I've identified the 50 moving average here. You can see the 50 crossed over the 200. That's called the golden cross. But what I have noticed a lot of times is when you have a golden cross, you initially are going to have a move back down. This is a longer term move up, but strangely enough, I've noticed that whenever the 520 cross or the 5200 or the golden cross happens, you get an initial kind of down move before it resumes its trend. So I've identified the 50-day moving average here. This is the gray line. This is right about 98.60. But now let's go over to the weekly and take a look at the weekly and see what that dovetails with. Well, if you go over to the weekly, see the big bar up? Remember how earlier I told you if you have a big bar down and you get to halfway, that's probably going to be resistance and head back down? Well, it's the same thing if you have a big bar up. A big bar up, not unusual for it to come back to halfway, but the 50 that I identified here as the level, if we go over to the weekly to see how that's half of the big bar up, we should find some support here on the weekly at about 98.60. And then on the daily, that dovetails nicely with the 50. Now here's the 300. I could take it off of the 300 if we had an intraday rejection of the 300 or a close under, close over. But I want to be patient with this one, and I really like the 50. So next week, if I get an intraday rejection of the 50, which means it goes below the 50 intraday and then closes back above, that will be my entry point. Or if I get a close under the 50 and close over the 50, that would also be my entry point. But the main point I want to make here is that on the higher time frame, this big up bar, it should hold if we get back to halfway of that big up bar on the monthly, and then the daily, that dovetails nicely with the 50. Alternatively, to the 200-day moving average here, I like upward sloping moving averages the best. Of course, the 50 is definitely upward sloping. The 200 is also upward sloping. So 2 moves here on Alibaba next week, if and only if it gets to these levels. Well, the 50, intraday rejection of the 50, or intraday rejection of the 200. Those are the 2 levels that I'm looking for, but only if they get there. Berkshire Hathaway. Well, Berkshire Hathaway has not really participated in this rally as much as the rest, although we moved up very strongly here when the market was not. But if we look back in time, if we look back at deep dip buys, well, do you see the confluence right here of the, or not the confluence, but you see the 250-day moving average? I know they're kind of nested here together, but the 250-day moving average, last time it intraday rejected that, it moved up nicely. So I am looking for next week for some kind of close under the 250, or close back over the 250. Also the 300 would work because we're upward sloping. And so next week, if we reject the 250-day moving average or the 300-day moving average, that will give me a good risk to reward ratio. Let's take a look at the weekly. Well, the line that I drew here at the 250 also dovetails nicely on the higher time frame, on the weekly time frame of the 50. See, there are going to be buyers at the 50, or there should be buyers at the 50 on the weekly, and then there would also be buyers at that 250 on the daily. So the more groups of buyers, the better. So based upon the weekly, the support of the 50 and the 20 actually on the weekly, that dovetails nicely with the 200. So again, the 250. So a rejection of the 250 would get me long Berkshire Hathaway, or also a rejection of the 300 as well, but only if it comes down there. Beyond Meat. Well, Beyond Meat's almost doubled. Look at this. It was 11 and it got to 22. So yeah, it actually did double. Unbelievable. This is a potential short for me. Don't know if it's going to get up there, but if we move up and we reject the 200 moving average up here, this would be a short signal. So either a intraday rejection to the upside of the 200, or a close over the 200 and under the 200. And let's look at the 200. I've drawn the line. Let's go out to the weekly, see if we get some kind of resistance levels here. Not so much. Nothing absolutely perfect. If it had dovetailed with the second ATR channel or the third ATR channel, would have been a little bit better. But still, it did reject. I'm sorry. The second ATR channel up here, the 200 here would be a little bit higher than that, but still a very, very good risk to reward ratio based upon this huge move up. I don't know if it's going to get there. I'm actually a little bearish on the market right now. But if it gets there, good risk to reward ratio, it would be a very extended RSI level. And so I'm just looking for some kind of intraday rejection up at 22.20. And if it does, I will get short. The market's rallied so much here, and so I am looking for more short trades to balance my portfolio. FCX, all right. Well, I told you at the beginning of the podcast, one of the trading approaches that I teach is called a return to value V1, V2, and this has the earmarkings of it. Not yet. It's not there yet, but remember, with return to value V1s, V2, we first have to close above the 1 ATR channel. That shows we're in an uptrend. Then we have to pull back into the value zone. That's between the two green lines. Well, we have pulled back into the value zone. We came down, we came down, we came down. We're moving sideways. You need sideways motion now. And what I'm looking for is a V1 or a V2. Monday, if we opened lower, if we opened below Friday's low and then closed above Friday's close, that would give a V1. Alternatively, Monday, if we go close lower, and then Tuesday, we get a V2. V2 consists of 3 bars. Bar 1, bar 2 has to wash out bar 1, and then bar 3 has to close above bar 1's close. That would be a return to value V1, V2. So we're in an uptrend. It's not unusual to have a bit of a pullback into the value zone. Need to go sideways, have a sideways motion to show that there's an equal amount of buyers and sellers, then have a false breakout to the downside, that's the washout bar, and then reversal back up. One of my favorite approaches, and again, this is one of the strategies that I teach in my one-on-one course in the evening time via Skype. So FCX, gold, copper, of course, metals got hit a little bit last week, but if I get a V1, V2, I will absolutely take this trade next week. Gold, well, geez, gold has just really had a crackdown the last couple days. We were above the value zone, came into the value zone, now lost the value zone. So now I have to look a little bit lower for some kind of support. And there's support here at the 250 and the 300. There's support here at the 200. Let's go to the weekly and identify on the larger time frame where some support would be. Well, there's a level of support here at the 10-day, but you see all these levels of support here on the weekly that are nesting. You have the 20, you have the 1 ATR channel, you have the 100-day moving average. This is a significant level on the higher time frame. So if we switch back to the daily of that line, see how that line reacts very nicely and dovetails with the 250 and the 300 here. So this is what I am looking for next week. A rejection of the 250 and or a rejection of the 300 SMA. It's down there quite a bit. Is it going to get there? I don't know. And if it doesn't, I'm not going to mess around with it. But if it does get there, that looks good to me. And again, because one, you have the 250 and the 300 just by itself. That's a good support level. But if you go over to the weekly, you see how that dovetails nicely with this nesting of moving averages on the weekly. So in other words, on the weekly, they're probably going to be weekly buyers that come in here at this support, and that dovetails nicely on the daily time frame here. So just to recap, if gold, GLD, does have a rejection of this 250 and the 300, I will be entering there. Of course, if it zips through there and rejects the 200, then of course I would buy. Look at the 200 over here. Look at this intraday rejection of the 200. Great risk to reward ratio. What a trade that would have been. So of course, if it gets back to the 200, it's respected it in the past, I would buy it again. But first one I'm looking for is rejection of the 250 and the 300 here, because on the weekly, that dovetails with a whole lot of support on the weekly. So hope that makes sense. Johnson & Johnson. Well, Johnson & Johnson, this is a deep dip buy strategy. We did go under 30 and then back over 30. Now that's a legitimate signal, but in an ideal world, I always like higher low V1s, V2s, under over 30 RSIs, rejections of 200s, 300s, 250s. Always higher low is better. Always, always, always than lower, because lower lows tend to bounce and then come back down. Well, we're at a 33.57. Like I said, at the beginning of the week, we did go under 30 over 30, which you would have had a profit. But what I'm interested in next week is if J&J does come down again and goes under 30 over 30, but it will come at a higher low level. The under 30 over 30 will be a higher low than the first under 30 over 30, and higher low anything are better. So what I'm looking for next week on Johnson & Johnson is an intraday rejection of the 30 RSI, or a close under 30 RSI and then back over, making it a higher low. So that is what I'm looking for on Johnson & Johnson. Just another under 30 over 30. That would get me long Johnson & Johnson. Merck, there's a confluence that doesn't happen very often. A market really has to come down strong. But I like confluences of 30 RSI in addition to a 200-day moving average or a 250 or a 300. But one of them that we don't talk a lot about is a confluence of the 100-day moving average along with an under 30 over 30. And you can see right now on Merck, we're at 31.82. So next week, if we come down and go under 30 over 30, and then we also go under the negative 100 and over the negative 100, that is a really sweet confluence of signals. And also you can see the negative third ATR channel is down here as well. So it gives a lot of potential entries. So the requirement next week on Merck is an under 30 over 30 as well as an under the 100 over 100. I put the levels down here. Let's take a look at the higher time frame and see if there's some support. No support really, other than it's right in the middle of the value zone, which is a support to me. So about 101.10, we're at 102.93. So we certainly could get down there. But again, under 30, over 30, and also an under the negative third, under the 100 and back over the 100, that is what I'm looking for to get long Merck. And Merck, certainly looks like it is ready for a bounce, and that would be a good confluence of signals. Pfizer, well, just like I talked about in Johnson & Johnson, same thing. Back here on the earnings day on the 31st of January, we had an under 30 over 30. That's a legitimate signal. We also had a V1. We also had a rejection of the negative third ATR channel. I didn't take this trade. We're now at 33.84, but this came from a lower low. If next week we could go under 30, over 30 again, and it came at a higher level than this first under 30 over 30, that's the better signal, and that's what I would be waiting for on Pfizer. Silver. Well, I've been talking about shorting silver, AGQ, for a long time. It just never got to my signal, unfortunately, but then it did come down in a massive way, unfortunately, for the silver longs. Let's take a look at the weekly on silver. Well, the weekly on silver, SLV, the 100 or the 200 week moving average, that is going to be an obvious level of resistance. So if we go to the daily dovetails on that at the 100 moving average here. So next week, if and only if on silver we reject the 100-day moving average, that will be my entry point. You could also use the 200 as well, but first stop would be a rejection of the 100-day moving average, and that would dovetail exactly with the 200-week moving average on the weekly chart. So that's what I'm waiting for. If it gets there, great, I'll take the trade. If it doesn't get there, I'm just not going to take the trade. And that's an important part of trading. On the weekends, when things are calm, you can look at these levels and go, hey, this level makes sense on the daily, this level makes sense on the weekly, this is my level. If it gets there, great. If it doesn't get there, I'm just not going to mess with the trade. And if you incorporate that into your trading, it's going to make a big difference. Okay, oil, USO. All right, well, let's look at the weekly, see if we can find some support. So when we look at the daily, we know where some weekly support is. Well, the 200-week moving average down here makes a lot of sense. And so if we go to the daily, if we expand that line out, you can see that line. Are there any support levels there? Well, there are going to be support levels there. It's a 36.82. If we get down to that level, we'll have a 30 RSI. So next week on oil, if we reject the 30 RSI, I will get long oil because on the weekly, that dovetails nicely with the weekly 200 days. So on USO, under 30, over 30. Walmart, this is a pretty easy one. Walmart has not participated in this rally like most stocks, but the 200-day moving average down here makes a lot of sense for me. This one's fairly easy. Rejection of the 200-day moving average would get me long Walmart next week. And then last but not least, XLV, which is healthcare. Healthcare has not participated in this rally. Let's look at the weekly first, the larger time frame. Nice support here at the 100-week moving average. I drew the line. Let's go to the daily and see where that dovetails. Well, that is going to dovetail very closely to the 200-day moving average. So next week, based upon the weekly with the 100 on the daily, a rejection in this area of the 200-day moving average would make a lot of sense. All right, so real quick, Alibaba looking for a rejection of the 50 next week. Berkshire Hathaway looking for rejection of the 250 if it goes down next week. Beyond Meat looking for a short with a rejection of the 200 if it goes back up there. FCX looking for a return to value V1 or V2. Gold looking for a rejection if it keeps going down of the 250 and the 300. Johnson & Johnson looking for an under 30, over 30, a higher low, under 30, over 30. Merck looking for a rejection of the 100-week moving average and the 30 RSI. Pfizer looking for a higher low, under 30, over 30. Silver looking for rejection of the 30 RSI and the 100-week moving average. USO Oil looking for rejection of the 30 RSI. Walmart looking for rejection of the 200, and healthcare sector looking for rejection of the 200-day moving average. All right, so let's head over to the weekly bars. Now, weekly bars, of course, close on Friday, so I will make any weekly trade decisions next Friday. Now, if we're trading the weekly bars, I want to look to the monthly bars, the higher time frame. First on deck is Boeing. Well, if we look at Boeing on the monthly, remember that's a higher time frame than the weekly that we're trading on. Here's the 50-month moving average, pretty significant level of resistance above, okay? So I've identified that on the monthly and gone, okay, level of resistance there. So on the tradable time frame, which is the weekly, where does that dovetail with? Not exactly perfect with the 200, but what I'm looking for next week, it's in that's pretty much the same area. I would be looking for a rejection of the 200-week moving average as a short position. And, later in the podcast, I'm going to go over the major indexes to kind of give you an idea. But I am getting bearish in this market now. Yes, of course, we've had this big move up. Friday, we had the unemployment numbers, and then Amazon, Apple, and Google all had kind of subpar results. And so I would think the two together would make some kind of bearish sentiment in the market. Actually, there's quite a few people that I know, traders that I know and respect, that are getting short now as well. So let's not forget about the short side. I'm certainly not on Boeing next week. If we reject the 200-week moving average, I would get short Boeing. Alphabet. Well, I already have Alphabet. Now, this one, I think unlikely that this is going to happen. But if it does come back to the 200, if we have a really bad week next week and has a rejection of the 200-week moving average, I would definitely get long. I don't think it's likely. Of course, I got out of the trade there near the top because right before earnings. But if we do have a move down next week and for some reason we do come back down, test the 200 and close back above, I absolutely would get back in Alphabet. IBB. Well, this one is definitely in the realm of possibilities. If we could move down, reject the 200-week moving average, it would give me a good risk to reward ratio. I would get long IBB with the intra-week rejection of the 200. India, wow, INDA. This one has really taken a big move down, but this one's probably pretty obvious to you. If next week we come back down and we have a rejection of that 200-week moving average, that would get me long. It would give me a good risk to reward ratio on INDA. But if and only if we reject that 200. Netflix. Well, let's look at the larger time frame. If we're trading the weekly, I want to look at the monthly time frame. Here's that 50 again, and it's also, see the move from the top to the bottom. See how we're coming right? We're rallying back about 50%. Well, 50% of a move back into a big down bar can add resistance, but also 50% move from the high to the low to the move could also add resistance. And so right here at the 50, that is a significant level of resistance on the weekly. If we go to on the monthly, if we go to the weekly, that dovetails perfectly with the 200. You see, on the monthly, the 50, on the weekly, the 200. So my move next week on Netflix, if we reject the 200-week moving average, I will get short Netflix. It will give me a good risk to reward ratio. Of course, I will position size. I'll place my emergency stop 2 ATRs above my entry, and then my end of week stop would be a close above the 200. And if it heads back down, gets my trailing stop level, then I'll go into trailing stop mode. I'll take partial profits on the way down. I know all sorts of rules here, all sorts of things, right? And again, just to remind you, I do teach private one-on-one lessons in the evening time via Skype, and this is what I will teach you. I will teach you step by step all 5 of the different trading approaches, and it's very important to me that my students succeed in trading. It really is. It's good for it makes me happy. It's good for my brand, and I just enjoy teaching it. So if this is of interest to you, just send me an email. Email is in the link of the description. So Netflix rejection of the 200-week moving average would get me short. Here we have Pfizer again. Well, look, let's go to the monthly. Look at some support. Well, the 50-month moving average here, about 39.50, is the upward sloping 50 on the higher time frame. If we go to the weekly, that dovetails perfectly with the 200-week moving average. It's quite a long ways away, but if it's $4 or $5 lower, but if it gets there, I'm buying. No doubt whatsoever. It'll give me a good risk to reward ratio. I'll position size, do all the things that I do. Doesn't mean it has to work, but I love the fact that on the monthly, we have the 50-week moving average here. On the smaller time frame, the weekly, it dovetails perfectly with the 50. So what does that mean? Most likely there'll be some buyers that come in on the monthly and also on the weekly. And the more buyers you have, if you have a bullish position, the better chance of it working out for you. So that's what I'm looking for, rejection of the 200-week next week. Silver on the weekly. Let's go to the monthly. Well, the monthly here has the 50 EMA as support below, and on the weekly, on the tradable time frame, that dovetails with the 200, and it's very likely that we could get there. So next week on silver, rejection of the 200-week moving average would get me long SLV. Tesla, of course, wow, what a move up in Tesla. Almost doubled. Incredible. Nobody wants it. Everyone wants it. Now, this definitely could come to fruition here. We had a nice close over the 200. So far, that's worked out well. I wouldn't be surprised by a pullback. If we could pull back next week, retest the 200, give me a little better risk to reward ratio, I would be buying Tesla. If next week we have another rejection of the 200 and it gives me a good risk to reward ratio. United Airlines, well, here we have the 200 above as a short. It did reject the 200 already. Let's go to the higher time frame on the monthly. Well, right up here, not exactly at any perfect location, but getting high in the value zone. But on the weekly here, if we attempt to go up again, reject the 200, that would get me short UAL with the stop with the weekly close over the 200. Oil, again, showing up on the radar here. If we look at the weekly, the higher time frame of the monthly, right here in the middle of the value zone with the 50-month moving average, that dovetails on the weekly with the 200-week moving average. And if it does get down this low, we will have a double bottom and bullish divergence. To see the low here, how deep these bars are, then we rallied and we got some green bars. If we come back down here, test this low, these red bars are not going to be as low as these. And this is what a double bottom and a bullish divergence is. Essentially, it's showing you that this move down had more sellers. Yes, we had a rally, but then if the move comes back down again and tests this low when we have less red, then we're running out of sellers. That's called the double bottom bullish divergence. I did study one-on-one with Dr. Alexander Elder, and he believes that double bottom bullish divergences are the strongest technical signal in technical analysis. I don't disagree, and I love that the double bottom bullish divergence would also dovetail with the rejection of the 200. So if USO goes back up, not doing anything with it. If it rejects the 200 week moving average next week, I will get long oil. And then last but not least, XLU. This one's pretty easy here. We had a nice close under, close over the 200, which worked out beautifully. But if XLU does come back next week, and only if it comes down and rejects this 200-week moving average, that would get me long. So let's go through them real quick again, just as an overview. On the weekly again for Boeing, if we reject a 200-week moving average above, that would get me short Boeing. Google, if and only if it comes back down, tests the 200, I would get long Google on the 200-week moving average. IBB, come down, reject the 200-week moving average, or the 200-week moving average, that would get me long IBB. INDA, if we reject the 200-week moving average, that would get me long. Netflix, if we go up and reject the 200-week moving average, that would get me short. Pfizer, if we come down and reject the 200-week moving average, that would get me long. Silver, if we come down and reject the 200-week moving average, that would get me long. SLV. Tesla, if we come back down, have a retest of the 200, that will get me long Tesla. United Airlines, if we reject the 200-week moving average above, that would get me short UAL. Oil, rejection of the 200 below on the weekly would get me long. And XLU, rejection of the 200 weekly, would get me long as well. So that's basically it. Oh, wait, no, that's not. Let's talk about the indexes. Let's look at the Qs on the daily. I think this is significant. I am starting to turn a little bit bearish. I think we've had quite a run. And, in my course, when I talk about getting out of the 70 RSI and rejection of the 70 RSI, close below the previous bar low. We spend a lot of time on that. That's usually the top of the market. And all of these things have happened on the Qs. We closed above 70 and then closed below 70. See how we're at 67.90. Just that by itself is a bit of a bearish signal. And then we also closed below the previous bar's low. So had I been long Qs here, I would completely have gotten out of my long position based upon these two events happening. And, we gapped down lower. We had this incredible rally. I don't know where that came from, but then the market kind of came to a consensus and came back down. But we went above 70, closed below 70. We also closed below the previous bar's low. That's significant. And doesn't mean you have to short that, but if you were long, that's a really good place to pull the trigger and get out of your positions. And again, if I was in the Qs, I would have gotten completely out of position. So this looks a little bit bearish to me. If we look over at SPY, same thing. We closed above 70, closed below 70. That by itself, not very bullish. We also closed below the previous bar's low, not very bullish. We also rejected the 300-week moving average, not bullish at all. So I am starting, that's why I incorporated potential short signals this week. I mean, it's so strong, it could go up. Don't know. But, just the way that I trade and what I teach here, this looks quite bearish. DIA, which is the diamonds, didn't participate as much, looking kind of weak here. And then IWM, which I am long, but same thing here. It did close above 70 and below 70. And in addition to that, the dollar had a big move up. You can see the dollar's been very, very weak here. Oh, look at this double bottom bullish divergence. Here's a low with red MACD bars. We rallied into some green. We came back, went lower without any red bars. This is called the double bottom bullish divergence with the missing right shoulder. That's quite bullish, and true to form, it is bullish. Now, the dollar going up here is most likely negative for the market. So as I showed you on the Q, SPY, diamonds, and IWM, we've lost the 70 RSI. We've closed below the previous bar's low. That's not good in general. But then when we look at other markets that have an effect on our markets, dollar getting stronger, VIX starting to come to life a little bit. That's why I got long. And then bonds had a big move down as well. And the more bonds go down, the more interest rates go up. So what I'm seeing big picture here, looking at the indexes, VIX, dollar, bonds, is that in my opinion, things are looking a little toppy. So don't forget, at least for me, don't forget to look for those short signals. I have so many long signals, and thankfully I've done well with them, but I am definitely starting to want to put together some short positions here at these levels. Yep, makes sense. So let's see, what else should we talk about? I think probably I've mentioned it a few times, but again, I do teach private one-on-one lessons in the evening time. I love to teach. I love that aha moments that my student gets when I teach them all of the different processes that I have. Again, I teach this one-on-one. I think it's the very best way to learn anything. I'm very patient, and you can ask me the same question as many times as you want. It will not make me mad. I just want you to learn how to trade the correct way. So if you're interested, the course does cost $1,750, but it's worth every penny. My email is in the link of this YouTube channel. If you want to start the process, just send me an email. Say, Greg, I'm potentially interested in taking your course. I'll say, great. Thank you so much for saying hello. Let's set up a Skype call. The Skype call is totally free. It is not a sales call. I promise. I just want to touch base with you, talk to you, learn more about your trading, your challenges, your goals, and then it's a great time for you to ask me any specific questions as well. And when we're done with the Skype call, I promise you I will not bother you. If you want, and when we're done with the Skype call, if in the future you are interested in doing it, you're going to have to contact me. But you're going to be happy you took the course. It's going to be money well spent, and you're really going to learn a skill. Now, if you like online courses, I have a great online course. It's so good. It's the Deep Dip Buy Stock Trading Strategy. It's at udemy.com. The link is in the description. It's very affordable. It's only between $12 and $15, but what a course you get for that. You get 26 videos, you get 9.5 hours of video, you get 15 study guides, and I teach you step by step how to trade the Deep Dip Buy Stock Trading Strategy. Not as good, of course, as the one-on-one because it's recorded and there's no interaction, but it is a great place to start. The links there. If you like the podcast today, if you found it helpful today or in any other week, I would really, all I ask is that you would hit the thumbs up button. It helps to build the channel, helps to keep the channel around, lets YouTube know that there's some valuable content here. So if you wouldn't mind doing the, hitting the thumbs up button before you get out of here, I would certainly appreciate it. And then last but not least, as always, the most important thing, please try to go out and do something nice for someone today. It's just good karma. It would make the world a better place. Can you imagine if we all just did one nice thing for another human being every day? It really would make the world a better place. And on top of that, if you could try to go out and do something nice for an animal today as well, they appreciate acts of kindness just like humans do. So, something I try to do, one nice thing for a human, one nice thing for an animal, and if we did, the world would be a better place. So I hope you've been having a good week trading. If you're long, I know you have. I appreciate you spending your time here. I hope it is paying some dividends and that you're learning some good things. And I hope you have a good rest of your weekend. And God willing, I will see you next week. And thanks so much for being here. And have a good weekend ahead. And on the way out here, I have to run the U.S. legal disclaimer. Thanks a lot, everybody. Take care. Have a great weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice. and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.